Fears of a slowing economy hitting stocks recently, not to mention concerns that tariffs will raise prices on consumers and lead to more inflation. It does raise the question of whether the market broadening that some have predicted can actually happen. Joining me here, Post 9, Sara Naison-Tarajano of Goldman Sachs. Nice to see you again.
Great to be here. Thanks for having me.
You've been talking about the broadening. Are you concerned now because of this growth scare, which we think is to play for this stock market uncertainty and upset recently?
Yeah, I still think that we're going to see a broadening of the market, and I think we are seeing that. I mean, if you think about the broadening versus the Mag 7, which we've talked so much about, right, the outperformance this year is pretty dramatic.
For sure.
We see the 493 outperforming the Mag 7, I think today more than 10%. If you look at what the last 2 years have been combined, the returns of the Mag 7 were over 200%, the rest of the market only 31%. So we're definitely seeing it happen. I think it's going to continue.
What is this about right now? Is it about tariffs and growth and the consumer wavering, all the above, plus other things? What do you think?
I think it's all the above plus other things.
Yeah.
No, I definitely think it's a bit about uncertainty, right? Markets, and I think that affects the markets and it affects the consumer, right? We have policy uncertainty around tariffs. We have geopolitical uncertainty around the Middle East and Ukraine. And then, some degree of regulatory uncertainty in terms of not knowing exactly what the path is going to be for this administration in the back half of the year. I think that uncertainty, coupled with the fact that we are coming off 2 incredible years of equity market returns, right? 25% last year.
Yeah.
And then, Tony was on the show and mentioned the back half of February tends to be historically weak anyway. All these things are coming together and creating some market volatility. I think it's to be expected.
Were you one in the camp who thought, well, the first half could be a little bit dicey, and then the second half, when you maybe get the tax cuts and the deregulation starts to have an impact and you get more deals done and more IPOs and things like that, then you'd have a smoother second half? Were you on with that view? And are you still, if you were, thinking that could be the case?
Yeah, I think that's what I was thinking and what I still am thinking, but I reserve the right to revise that view based on how all this policy comes out. But I think, look, our base case, I think the tariffs are going to be an important part of that, right? They're going to be an important part of what happens to inflation, which has a broader impact on the economy. Our base case is that we're going to see a 4% increase in the effective tariff rate. That only actually has a 40 basis point impact on core PCE, only a 20 basis point impact on GDP, only a 1% hit to S&P 500 earnings. So, if our base case persists, I think we can make it through this first half. I think it's a little bit, I heard Rick Reeder speaking about this, the market needs, there haven't been many opportunities if you haven't been long the stock market to get involved with what the market has done over the last 2 years. So I think it's a little bit of a clearing out that's a bit necessary, and the hope, if we can stay on track, is that the second half will be better.
You hit on maybe the most important word of all, and that's earnings.
Yeah.
Ex-energy earnings growth is 20.4% this season. All in, 16.9. That's what we needed.
This is really good. The estimates expected something like 8% earning growth. We expect 11 in 2025. These are not signals that would concern you about the U.S. stock market. And by the way, you want to be long the U.S. stock market if you're worried about inflation. The U.S. stock market has over cycles.
So what do you think then about what you hear? Better, Europe is better, China's better. It was so bad and there was so much value, but much more risk. But now things have turned a little bit, and there's going to be better returns coming from Europe and elsewhere in the world than here. Yeah,
I would say from a strategic asset allocation perspective, we still favor overweight U.S. for all the reasons you spoke about. It's about what our GDP expectations are at close to 2.5%. It's about earnings growth. There's no question there's been some tactical opportunity overseas. Well, it's been really cheap, but it's pretty cheap for a reason. If you look at the GDP expectations in Europe, it's 70 basis points, right? So I think it's interesting for a tactical trade, but when I think about strategic allocations for clients, I think we want to be thoughtful about international allocation.